Good morning, everyone, and thank you for joining us for this morning's webinar, Rising Rate UITs. We have a great lineup of panelists for you today. I'll give you an introduction. Today we have John Cole-Scott, Portfolio Manager and Executive VP of Closed-End Fund Advisors. John has worked at the firm since 2001. He sits on the firm's investment committee and holds the FINRA 66 license and the Certified Fund Specialist designation. He's a graduate of the College of William & Mary and has been quoted widely in the financial press and presented at conferences and for investment groups on more than 40 occasions. In 2008, John founded CIFA's Closed-End Fund Universe, a comprehensive weekly data service covering 165-plus data points for all U.S.-listed closed-end funds and 100-plus for BDC funds. He also founded and manages the CEF Network, a CEF Network group on LinkedIn, and is the editor of the firm's blog. John is a board member of the Richmond Association for Business Economics and serves on the investment committee for the New York State Society of the Cincinnati. We also have with us today Kevin Mon. Kevin Mon of Henyon Walsh. Kevin Mon joined Parsippany, New Jersey-based Henyon Walsh as a managing director in 2004. He's currently serving as the president and chief investment officer of Henyon Walsh Asset Management. Mr. Mon is responsible for all of the wealth and asset management products and services offered at the firm, including fee-based money management and the various portfolio strategies within the Smart Trust series of unit investment trusts. Mr. Mon was also the former portfolio manager of the Smart Growth Mutual Funds. At this point, I'd like to pass this on to John to start our webinar. John?
Great. Thank you very much, Patty. This is the fun disclaimer that everyone loves to read, so feel free to forward to the next slide. All right, so not everyone on the line may know about our firm, so I'll give you the 1-minute overview. We are a family-owned investment management research data firm. We specialize in closed-end funds and BDCs. We are well known for our newsletter going back to the 80s called the Scott Letter, the Closed-End Fund Report, where we give life to the story of a manager, the sector, his track record, and to help show investors what the closed-end fund structure does around an investment strategy. Our main business has historically been discretionary portfolio management or separate account management. We have 9 different portfolio models. In the last year, we've connected with Smart Trust for a UIT, hence why this topic is very timely for us today, and our portfolio consultant for their BDC UIT. And we also have 2 models launching soon on the Covestor website. It's a robo-advisor platform, one on the muni side and one on the BDC side. One thing that powers our work, makes us a little bit different than other firms in the sector, is we actually have internal data analysts that collect every filing, fact card, news note, discussion on every closed-end fund and BDC, and it gives us a timely and perspective on what's normal and what's happened historically for all closed-ends and BDCs. And then we do some institutional consulting, some individual investor consulting, some fund sponsor consulting as their needs pop up. And like Patty said, LinkedIn was an early part of my career. In the fall of 2008, when I was looking for any way to grow my business or to make the business survive, we thought LinkedIn would be a great place to connect closed-end fund interested folks. And while we are the founder, it's definitely a forum for anyone that cares about the BDC or closed-end fund sector. And we're 25 years old, very happy to be here. Next slide. So closed-end fund or BDC, which is the part of the 3 UITs we'll talk about today, a big chunk of most of them, not all of them. They are a fixed capital, so they're born IPO'd like a regular stock, but they're a 40 Act diversified investment. There's no redemption pressures where managers at the closed-end fund level have to sell things to give investors their money back in a panic and buy things to make the portfolio bigger with exuberance in the market. One of the best and basic features of the structure that makes us very, very happy. And again, they're actively managed, which means managers can make tactical decisions through cycles in the market, and they are governed by the 40 Act, which in my opinion takes a lot of the risk and adds diversification to the investment. They're publicly listed, so investors can change their mind and buy more or sell some every single day in the market, whether it's institutional investors like ourselves or whether it's investors that do it themselves or even through the UIT wrapper that involves closed-end funds and BDCs. We find they're inefficient and volatile. Volatile, in our opinion, is not risky. To me, risk is defined by the likelihood of a negative outcome, and the fact that these things trade actively or are owned by a lot of individual investors, they sometimes make strange decisions. There are weeks where we know why stocks go up, closed-end funds go up and down. There are weeks where we have no idea, and typically they revert back because it's a short one-time thing. That alpha is exploitable if you pay attention and know what you're doing, and is a great way to use the UIT wrapper to set that at various points during the year. They're generally yield-oriented. I'm hoping the future will provide less yield-oriented closed-end funds, maybe more interesting strategies that can be done well. But they're also, again, total return vehicles. Yield's important, but obviously the price you paid plus dividends is also very important. And BDCs, which are technically closed-ended management companies, though people think of as separate entity, are very, very similar. Just a slight modification of the 40 Act done by Congress in 1980. And when I talk about BDCs, I say Congress did something useful but a few years ago. Next slide, please. So it's hard to talk about closed-end funds and BDCs and not talk about the discount. This is all BDCs is a red line. There's about 43 debt BDCs now, about 50 total BDCs. There's about 600 total regular closed-end funds. Closed-end funds make up a third equity, a third taxable bond, and a third municipal or tax-free bond. But all I can say now is that while they may have come up a little bit from their lows and their big groups, both closed-end funds now are historically cheap, and BDCs, while they're off their lows from last year's fourth quarter and early January, they're still significantly cheap, historically speaking. And so if you're going to buy a structure that gets you exposure to these vehicles, it's much better to do it when they're historically cheap versus historically expensive. Next slide. So rates might go up this year. I'm actually re-interviewing a convertible bond manager next month for our newsletter, the Scott Letter, and I noted that I interviewed him 3 years ago, and in the interview 3 years ago, I talked about the pending rise of interest rates. I know Kevin Mon and I have talked about the rise of rates and when it might occur. We generally agree for the timing of it, but so we don't know when it will happen, but we know that it should eventually happen. So we did some research last summer because we feel it's even closer to when it can happen. What happened in two pieces? What happened to the yield of the broad closed-end fund sectors when rates went up last time, which was March of 04 to September of 07, and what happened as an average total return on market price? So we obviously, the best environment for closed-end fund investing is you buy a good manager in a good sector at a relatively cheap price, it performs well. The dividend is stable or goes up. So what I can say here is yields don't always go up. But if you look even for most of the sectors, the performance was positive for every single group. And outside of some of the specialty equity funds, which has some enigmas in it, in my opinion, and the state muni bond funds, which again has some enigmas in it, almost every fund was total return positive, and the yields for most of the funds went up. Now, equity funds do some crazy things because they're not just yield vehicles on the U.S. and non-U.S. side. But the takeaway here is yields can come down, and yields can go up, but total return was not painful if you'd owned it literally from the start of the rise to the end of the rise. And it tells us that while you should position yourself during the rise of rates, it doesn't mean stay away. It just means be thoughtful about asset allocation and be mindful of which sectors are better versus worse. So conceptually, the gray bar here tells us that 97%, that lower right-hand corner, 97% of all closed-end funds and BDCs changed their distribution policy when rates went up. So when investors that are newer to investments that contain closed-end funds, like the UIT wrapper, remember, dividend changes are going to happen. Just try to experience the up changes versus the down changes, and that's why it's helpful to have someone that knows these structures pick the investments to be holding in the portfolio. Next slide, please. So this breaks into some sectors that we might be talking about today. And again, because taxable bond funds, there's a whole smorgasbord of fund sectors that make that up. Again, lots of yield reductions. In fact, the only one that had increases, surprising surprises, loan participation funds, because those is access to variable loans, which is designed to pay you more when rates go up, and they proved that they did it. Multi-sector bond funds also had a very positive experience. My opinion would be that active managers with a wide bond mandate can manage a portfolio through a rise in interest rates. The only equity sector that had a challenge on yield-wise and performance was lagging was preferred equity. And I can say that it wasn't a horrible experience, but preferred equity is actually more bond-like, in my opinion, than convertible bond funds, which are another sector that actually did pretty well. So all in all, performance was rather good, not home runs, but rather good in yields. If you pick the right spots for rising rates, actually can grow with you, which helps investors meet their retirement goals. There's a whole white paper that these tables come from on our blog, and you can find it by just looking for, just searching the rising rates on our blog, cefblog.com. Next slide. I'm not going to cover this early, but people say, what do you manage model-wise? These are the 9 models. The newest is the BDC model, which launched just around the time of the UIT we did with Smart Trust. And that's just what we do. And if you go to the next slide, it'll be in the slide deck later. It'll actually give you the performance for those models in case you want to see how we've handled different time periods. Go ahead and go to the next slide. So one more slide after this. There we go. So this is pretty much the end of the intro for me about rising rates with a closed-end fund lens, and I think Kevin Maughan's going to dig into the UIT basics next before we dig into actual UITs.
Yes, thank you, John. I thought it'd be helpful to all the participants on the call before we went into specific UIT strategies that John and I have come up with to deal with a rising interest rate environment, to do a quick overview of UITs themselves for those who may not be familiar. Unit investment trusts are another 40 Act type of structure with 2 primary differences from your traditional mutual fund or exchange-traded fund. First being there's a fixed term to unit investment trust. The majority of UITs available in the marketplace today are anywhere between 13 months to 2 years in duration, and the portfolio itself needs to remain static for the life of that series of that trust. So with that being said, it's very important for investors to realize that today's UITs aren't your father's UITs. There are many more innovative strategies that are employed through a UIT today than there were back in the 1980s when there were features such as the Dogs of the Dow Trust or the Lehman Brothers Uncommon Value, which were essentially trusts of a limited number of common stocks, or such as the Empire, the Glickenhaus Trust, trusts of individual municipal bonds. Now we package everything from closed-end funds to BDCs to ADRs to preferred stocks to convertible bonds to single-issue bonds to exchange-traded funds to common stocks to REITs, all in various UIT strategies meant to deliver either total return in opportunities or high streams of sustainable income. UITs certainly have grown in popularity in recent years. At the end of 2014, according to the ICI, there were over 5,380 UITs in existence with assets of over $101 billion, the highest total in the history of UITs. There were 6 major sponsors of UITs in the country, of which Smart Trust is very fortunate to be one of those. For more information on Smart Trust itself, you can go to www.smarttrustuit.com. Now, moving on to the specific strategies, as you'll see on the slide in front of you, we came up with this strategy for our rising interest rate hedge trust primarily in response to advisor demand. We work with advisors, whether they be with independent broker-dealers, regional broker-dealers, RIAs, wirehouses throughout the country, and it's their feedback that's applied to us that generally forms the basis for the strategies we come out with. And what they told us was that their end clients were looking for a trust or a strategy that they could put into their portfolios that would provide a hedge for when and if, as John points out, rates do start to rise, but would also not force them to give up too much income that they would need to sustain their lifestyle and that they were looking to from their portfolios. In terms of our outlook for interest rates, yesterday's Federal Reserve meeting didn't really change our outlook, and we're primarily relying upon their transcripts and the outtakes of their meetings to form our outlook, but we do believe that this time around it will look very similar to the 2004-2006 timeframe when the Federal Reserve did raise interest rates 17 different times over those 3 years at 25 basis points a clip. Again, it's still subject to debate when that first rate hike will occur, but we do think it will be on a very sustained and drawn-out basis. I contend that the Fed funds rate will likely be 50 basis points by the end of this year, and judging by the average analyst consensus of the 17 voting members of the Federal Reserve, it should be around 2% by the end of 2016. So again, rates will start to rise, but it will be very slow, and it won't be any dramatic rises, at least any time in the near future. So what can you do to prepare your clients for that type of likelihood? we went back and we looked at the period 2004 to 2006 to see which sectors, which asset classes performed best when the Fed did embark upon that slow, gradual tightening program. We also looked at another period between 1994 to 2013 to observe what happened to different asset classes and sectors when yields rose, even though the Fed didn't do anything. So exactly the period we're looking at right now, or at least earlier in 2015, when yields started to rise, although the Fed had yet to start upon their hiking. So we looked at those two periods, and those determined the basis for the asset allocation strategy for this particular portfolio. So you'll see, as it indicates on Series 4 fact card of this particular strategy, that we have 40% allocated to common stocks. We have 30% allocated to senior loans through closed-end funds. We have 10% allocated to convertible bonds through an ETF, and we have 20% allocated to inverse U.S. Treasuries, non-leveraged inverse U.S. Treasuries through ETFs. And the two ETFs that we use in this portfolio align with the types of treasuries that are currently on the Fed balance sheet. As you know, $3 billion, or roughly 75% of the balance sheet of the Federal Reserve today is in U.S. Treasuries. The bulk of those are in that 7 to 10 and 20-plus year time frame. So if, in fact, as some of my colleagues believe, that the Federal Reserve won't just look to raise interest rates for this particular tightening, but will also start to look to unwind their balance sheet, well, these particular ETFs would benefit from the Fed starting to sell those treasuries back into the open market, thus pushing down their prices and increasing their yields. On the stock side of the portfolio, the sectors that we believe will perform best in a rising rate or yield environment based upon our research are sectors such as energy, materials, financial, specifically REITs, telecom, and utilities. Now, a lot of times when I go through these presentations with advisors and I mention REITs and utilities, their jaws drop. They don't understand, because it's always been their conception that as rates start to rise, utilities will get hammered. REITs won't do as well because REITs are associated with the housing market, and housing doesn't do well, and mortgages are more expensive. And all I can tell you is that REITs aren't just housing. REITs are a very diversified marketplace, and sectors of the REIT marketplace, such as retail, residential, healthcare, self-storage, all stand to benefit from a gradually improving economy, which we believe will coincide with the Fed actually starting to raise interest rates. And utilities, on that front, you know, as I said, if the Fed is right and the Fed funds target rate is 1.75% to 2% by the end of 2016, well, all of a sudden those utilities that are paying 4 to 4 or 5% don't look too bad on a relative basis to provide a high level of sustainable income. So that's the basis for this strategy. The current yield on that portfolio, based upon the current offer price, is just under 5%. So you're certainly getting paid while you wait for rates to rise. And some of the advisors that we work with are using, you know, let's say a 5% sleeve in their bond portfolios to not give up income, but provide their clients with some interest rate hedge protection through this type of vehicle. And with that, I'd like to pass it back to John to discuss another strategy that's built to provide a high level of what we believe to be sustainable income and growth potential in a rising rate environment, and that's our BDC trust. John?
Great. Go ahead and advance the slide one more. I guess one more? Oh, one more. There we go. So this is the third series of our Select BDC Trust, and I'm going to suppose there's at least a handful of folks in the line that may be unaware or not aware enough about what a BDC is. So Business Development Company is a closed-ended management structure. It's diversified and regulated like a closed-end fund, but it kind of is traded and researched more like an operating company or common stock. But there's advisors I meet with regularly that don't realize they own a BDC and that it is technically a closed-end fund. There are 5 debt-focused BDCs, which means they write loans to small, private, or low market cap companies here in the U.S. It's a U.S. investment. We accentuate the loan or the income part of the BDC sector. There were only 5 of those alive back in 2004 when rates were rising. When we pitched this idea to Kevin, the reason he hired us is I said last time BDCs went through a rise of interest rates, their yields went up on average about 5%, and their total returns were positive, almost as good as the S&P 500. And now there are 43 debt-focused BDCs. So what happened? We had a financial crisis, followed by some legislation that made it very, very hard for banks, as advisors might know, if their clients have small businesses, it's very hard for their clients with small businesses to get loans to grow their businesses. So the BDCs have taken these private or level 3 assets, the work of lending to U.S. small businesses from the banks, and have grown this sector. One way they're different is BDCs typically come from a diversified platform of private venture debt investing to businesses. And they have human capital, which means good attorneys, good CPAs, good people that understand management consulting and how to grow the sales side of a business and the distribution side of a business. And they can write a loan to this company, and often, and we've accentuated in this trust a couple of features. Feature one is over half of the loans in this UIT, which is made up of 10 different BDCs, are first lien loans. And if anyone has a mortgage, sometimes people have a first and a second. Something goes wrong, the first gets paid first. So it's better to be in first lien loans. However, the yields typically are lower because they're more secure. Almost a quarter of the loans in the portfolio are second lien loans. So just under 75% of the investments in this diversified trust are collateralized and senior obligation investments. That's helpful. We're talking about rising rates here. So many of the loans, right around 75% of the portfolio, are variable loans, which means they're LIBOR plus 6, LIBOR plus 7, LIBOR plus 8. Depends on the credit and the confidence of the investment bankers who produce these loans. And that means when rates eventually go up, this portfolio will act in a better environment, in my opinion, than the average BDC in the market, with yields increasing. That being said, BDCs are cheap. We have it on some of the research we showed you a minute ago on the pre-slides, but BDCs used to be at 5 to 10 premiums in the sector. Right now they're about a 5 discount. Our trust is at about a 9 discount, which is a little wider than the sector average. So this has been an investment where we feel it's a good entry point. It's a portfolio of diversified loans, mostly variable loans, mostly first lien and second lien investments. And here's what's interesting. There's over 1,000 companies in this portfolio, so people worry about risk. They wonder, how do I avoid that risk? And I haven't said it's almost a 10 discount, 10 different managers in the space, and it's a 10+ yield. And usually when an advisor hasn't met a public BDC that trades at a discount with modest leverage, they go, how the heck can they do a 10+ yield? And I go, it's very simple. They're investment bankers. They write deals that they want to take on, and companies that have a good business plan accept the deals. They leverage it a little bit, very much like a regular closed-end fund. The weighted leverage here is about 42%, and it allows them to give that 10 yield through rising rates in a consistent basis. When I think about the risk of this, it's a good replacement for some high-yield bond exposure or some traditional senior loan. Not a full replacement, because this is a sector. So this is a sector that helps diversify the correlation or asset allocation risk of an advisor's portfolio for their clients. It's a chance to juice the yield a little bit, because adding a 10.5 yield is easy to offset other pieces of the portfolio to bring the yield higher up than others. For example, for our high-income clients here at our firm, BDCs make up a 20% allocation, which is an overweight by most accounts. In our foundation balance or traditional 60-40 mix, it's an 8 to a 10% weighting, which is still more than some people might offer. 3 to 6% is not a ridiculous level of BDC exposure, and yet we're in an environment with competition, options. This is my opinion, my top quartile of funds that I like in the sector, set for rising rates, sets for discount reversion, and a chance to do very, very well. And I know Kevin knows this product well. I told him if I forgot anything to please chime in, because I usually am on the road with some of his guys, and they always help me forget what I didn't say. So did I miss anything, Kevin?
No, that's excellent, and I'll be touching upon BDCs once again in the next UIT strategy we discuss.
Perfect. So with that, I don't see Questions come at the end, but go ahead and jump into the next UIT, Kevin.
Wonderful. If we can just go one more slide there. Excellent. So the next strategy that we have in place that we feel is pertinent for those advisors looking for a strategy that is oriented to perform well in a rising rate environment is our dynamic sector income trust. And by the very name of that strategy, we are attempting to select sectors for each series of this strategy that we feel are best positioned over the life of that series of that trust to provide a high level of sustainable income with the opportunity for capital appreciation over that 2-year time period. And this is an excellent example of a multi-asset approach or a diversified asset allocation approach to providing both income and growth potential in a UIT strategy. You'll see from this slide in and of itself how many different types of asset classes and how many different types of security types we use in this portfolio strategy. Again, I challenge a lot of the advisors on this call now to find another type of wrapped product out there, whether it be a 40 Act or a non-40 Act structure, that incorporates this many types of security types, asset classes, and sectors into a given strategy as the dynamic sector income trust. Another feature that you should keep in consideration when you're looking at these type of multi-asset approaches is that not only do we use single issue securities such as REITs or stocks or ADRs, but we also use closed-end funds and in some cases exchange-traded funds to implement certain asset classes and sectors. So where in my earlier comments about UITs, I stressed that 2 of the primary differences between a UIT and a 40 Act mutual fund was the defined life and the static nature of the portfolio. If, in fact, I'm using a closed-end fund, even though my allocation to that closed-end fund is static, the actual closed-end fund itself is being actively managed by its underlying portfolio manager. So you do have some elements of active management underlying a passive security structure. And I think that's very important to emphasize when talking about these types of strategies with the advisor's clients in the event that they have some apprehension about a 2-year strategy or 2-year portfolio where the portfolio is essentially fixed. Let's look at the underlying security types to see if, in fact, there's any actively managed element to that. And let's also understand how the other securities were selected and were they selected in accordance with a 2-year investment time frame, and what are those investments attempting to achieve? Are they looking to achieve income? If so, what's the sustainability of that income? And if they're looking to achieve growth, what is the basis for how the stocks were selected to provide growth over the next 2-year period? So going back to our rising interest rate hedge trust and the earlier comments from John on BDCs, all of these individual security types, we believe, based upon our research, whether looking back to previous periods where the Fed increased interest rates or previous periods where the 10-year U.S. Treasury yields rose by 100 basis points or more, speak to these areas of the markets that we're looking to invest in. MLPs on the energy front, again, energy was one of the top performing sectors that we looked at through our research. International, we certainly have all noticed the increased sentiment and appreciation for international investments in 2015, and we do see more risk-adjusted return potential in international markets versus domestic over the intermediate to short term. High yield was one of the best performing asset classes, again, when the Fed raised interest rates last time. Senior loan closed-end funds are floating rate funds. Same thing with the BDCs we selected in this particular portfolio, are generally receiving floating and have locked in their leverage cross fixed. So as rates start to rise, that spread should only improve, as John alluded to earlier. Preferred stocks are off to a good start already in 2015. They should continue to perform well as rates start to rise. Common stocks, we picked those stocks in those sectors, once again, energies, materials, industrials, telecom, and utilities that have performed well previously in periods of rising interest rates. And then, of course, non-mortgage REITs are 25% of the portfolio and are diversified REITs in areas such as retail and residential, hotel, self-storage, healthcare REITs as well that we believe should do well in an economy that's gradually improving. The yield on this portfolio is just over 6% currently based upon its current offer price. And I just want to remind everybody that all my comments today, and I know John's as well, are for educational purposes only, and we should not be considering them as a solicitation to purchase or sell any of the UITs or investment themes that we mentioned today. So I know we've run a little bit over a half hour there, and I apologize if I was part to blame for that, but I'd love to pass it back to Patty now or John and see if we have any questions from the audience.
Yes, we do have some questions that are coming through, and I just want to remind the audience, if you have any questions, just feel free to jot them in the questions box, and we'll have our panelists answer them. So for right now, I have a question for John. What will the Fed tightening process look like this time around?
Well, I'm sure Kevin can add some perspective too, but I mean, what we've seen is that with nominal GDP right now trending 3.5%, 4%, and rates being essentially zero, there needs to be a path of improving and increasing rates at the Fed level. I think the Fed doesn't act fast enough. The markets will encourage them along the way, which is not the preferred outcome in my experience. What we think will happen and what most people think will happen, I think people are in two buckets. Either it's going to happen like 5-10 years from now, or it's going to happen soon. There's really very little middle ground from the strategists and economists that we track. It's going to be a small increase every other meeting. We need to start the process, in my opinion, yesterday, because as I chat with advisors, or I have 50 direct private clients I work with, we chat about the risks we see in the markets. And one of the risks is that we don't get rates high enough so that if there is a problem that we never see coming when they happen, we can lower them again later. So to me, the unemployment rate's 5.5%. It's not perfect, but it's way better than 5 years ago. I know it's a lot harder for the small business owners I work with here in Richmond, for either a vendor or as a service provider to me personally. They're having trouble hiring as good of people as they were a few years ago. The labor market's stronger. The housing market, broadly speaking, is expanding and progressing slowly. Rents are expensive. Houses are cheap. So I think that slow pace of increases is the likely path. I think that they've been communicating this well to us. I think they're not going to surprise the markets. But that being said, I've been on the road talking about the UIT BDC since October of 2014. I've tried to tell every advisor I sit across the table from, when rates go up, everything yielded is going to have a bad day, week, 2 week, we'll see. But what you need to do is pick guts that handle that environment well, and remember that short-term irrational behavior, if you look at behavioral finance, give you some amazing opportunities to reallocate a little bit, to double down a little bit, and to add into the experience. So the short answer is I would say a slow pace, and I hope that they're just wise enough and enough people encourage them to do it sooner than later. If it's not by September, I'm disappointed, and I think the markets may eventually encourage them, which is not the preferred outcome. Do you have any comments on that, Kevin?
Yeah, the only thing I would add to John, and I agree wholeheartedly with his sentiment there, is I think that the media, for the most part, in the market, participants somewhat are misguided with their overarching concern about when the first rate hike will be. I'm much more concerned, I'm much more focused on the pace and the duration of this particular tightening cycle. And will it be like 2004 or 2006, or will it get to a point where, as opposed to having these slow measured hikes, the Fed now has to play catch up and starts to have some 50 basis points to 75 basis points hike in a given increment. So again, though, I think they're very hesitant this time because, as everyone says, this time it's different, and we can only go based upon their outtakes. But looking at the gradually improving nature of our economic base here, I do believe that they will start to raise interest rates in 2015. I agree with John. I think they should have already done it after this particular meeting, and we'll see what their revised guidance is. But if they're looking to get to 1.75 to 2% by the end of 16, well, then we could expect to see a number of measured short-term hikes over the course of 2016 as well. So whether or not you use any of these particular UIT strategies you spoke about today, or some of the underlying securities based upon the research that we provided on your own, I think it certainly is worthy of everyone's consideration to start looking to plan for a rising interest rate environment, at least for the next 2 to 3 years.
Okay, great. I actually have a question for you, Kevin, that came through.
Sure.
How can advisors research the interest rate sensitivity to NAV and a fund's yield?
Yeah, it's a great question. So if you look back historically at any of the underlying securities that we have in any of our trusts or any of the securities that they're considering putting into their client portfolios, we went back and we just looked at the overall interest rate sensitivity, changes in price, changes in yield, changes in distribution that occurred between 2004 to 2006 when the Fed embarked upon this gradual tightening program the last time around. And we also looked to see, every time the U.S. 10-year spiked by 100 basis points or more and observe the reaction that these securities had when that happened. So let's say, for argument's sake, the Fed does nothing in 2015, but we start to see yields spiking and people selling bonds to get out in front of the Fed starting to unwind their balance sheet. Well, how are the securities going to react to that type of situation before the Fed does anything? So that's, once you have the securities you're considering, if you have a Bloomberg, if you have access to Morningstar, you can observe during those time periods how these securities did behave, what happened to their respective premium and discounts, what happened to their respective yields, and make your determinations using that information.
Okay, great. Just a reminder to everyone, if you have any questions, just mark them in the questions box. I have another question here for you, John. How are closed-end funds expected to perform in a rising rate environment?
Yes, so we try to cover that on the front end with some of those slides. And I think that there's a couple of points that I really try to remind, especially newer to UITs with closed-end fund exposure or newer to closed-end fund investors on their own. Closed-end fund distribution policies are, like I just said, they're a policy, not a promise. We see a lot of crossover investors into closed-end funds or UITs of closed-end funds with that I was in a bond and then I can't get a 5% muni bond exposure, so I'm going to get a 6.5% closed-end muni bond exposure. And we have to remind them, like I said earlier, that 97%, which is a lot, of closed-end funds change the distribution policy through that rise of interest rates, and even through a non-rise. We've been doing our quarterly research call for investors for so many years, I can't remember when we started it, but about 10% of all closed-end funds change the distribution policy every quarter. Sometimes it's 9, sometimes it's 11, but it's really an ongoing process. And so sometimes investors just think about the indicated yield, and they don't think about what the sector is. So if you're in a sector that that's going to underperform in a rising interest rate environment, or that's underlying investments are going to be having yields trend down, be thoughtful that the distribution policy might go down. And it doesn't mean you shouldn't buy that allocation. It just means you have to temper that into your process. So when we research closed-end funds, it's not rocket science. We really try to balance, three things. We call our closed-end fund trifecta. Is the market price versus net asset value at a good point historically and relative to peers? Because up gravity of the market price going up versus down gravity of potentially it falling farther and faster than its peers. Second is that dividend sustainability. We actually back out leverage and discounts and look at what the portfolio has to hit to match the board of directors policy as a guideline. And if you're in a sector where you don't believe the guts can meet that policy, then don't believe the distribution that's currently in place. And third is, remember, closed-end funds, which is our specialty in BDCs, they are actively managed blocks of capital. So there's a cost of management and running the entity of a closed-end fund, and there's the investment results of their work. So we do net asset value, total return performance. We do 6-month, 1-year, 3-year. We're getting close to 5-year data that we control, and we're able to judge successful managers. Some closed-end fund investors only seem to care about expense ratios. That's important, but I'd rather pay a little bit more for a better manager than pay a little bit less for a worse manager. If you do that, the concept of what sector you should be in, lean into the multi-sector on the bond side, lean into the senior loan on the bond side, lean into BDC, lean into convertibles, because those are areas on the closed-end fund side where they are designed to do well in a rising rate market. So part of it's logic. A 10 yield doesn't mean it's earning 10, and part of it is diversification and making sure that you're not overexposed to any one sector.
Okay, great. Have a question here now for Kevin. For closed-end funds and BDCs, how do you balance dividend risk with the goal of solid return growth for your investment strategies?
Sure. So it depends on what the particular objective is for one of our given trusts. So if I am looking to build a trust with a primary objective of providing a high level of current and sustainable income, I'm looking at a couple of key factors to help support that very objective. I'm looking for what that closed-end fund or what that BDC, for that matter, is currently earning versus what they're currently distributing in income. Generally, I prefer those funds that are earning more than they're distributing, because if, in fact, they're earning less than they're distributing, at some point in time in the future, that generally tends to lead to a distribution cut. I prefer not to have closed-end funds in my income-oriented portfolios that experience a distribution cut over the life of a given trust strategy. I then look to see if, in fact, they have a positive UNI balance, or undistributed net investment income. That's akin to a cash reserve, if you will, for a portfolio manager, such that if, in fact, the earnings in their portfolio does decrease, they could dip into their cash reserves to help support any potential distribution cuts. Lastly, after I look at that, I look at the nature of their distributions. Are they purely income distributions, or are they returning capital? I don't consider a return of capital to be part of an income stream. If you're just giving me back the money I invested, you're not providing me with additional income, and that's not supporting the overall objective of that trust strategy. Lastly, after all those things are considered, I'd look to where that particular closed-end fund is trading relative to its NAV. Because as John will correctly point out, there's nothing written in stone, and there's no law that's ever been passed that says a closed-end fund ever has to trade at its NAV. So the mere notion that a closed-end fund is trading at a discount, a 2% discount, a 3% discount, doesn't mean that it's on sale or that it's going to appreciate over a given defined period of time. But we do care about that information. So we look at where a particular closed-end fund is trading relative to its own 52-week average and relative to its peer group. If it's trading below both of those, then we think there's relative value there. And based upon the asset or class or sector that it's investing in, that gives us an opportunity to try and get growth potential in those areas if it's one of the sectors we like over the life of that trust.
Okay, great. Question here for you, John. A review of the UIT product structure and growth of the UIT marketplace.
Oh, I mean, we've been able to witness it, the last year or so by partnering with Smart Trust. I mean, honestly, when I took my Series 7 exam in 2001, I studied the UITs as much as the average advisor studies closed-end funds. I think there's maybe a half page on each. But what I really, I've seen that's helpful with it is I've been on the road talking with advisors how they've used them to build their book of business. Is it really gives that wrapper around a strategy where it's one investment that's diversified and very transparent. So the growth has been the fact that investors like to know what they own. We found investors also hate taxes, and while we can be tactical with our private clients, it's very helpful to have an investment where the expectation is long-term capital gains, not short-term. It creates a better after-tax environment. So I know Kevin can add a couple of points to that question as well, but it's been really neat to see the diversification of the wrapper tempering the volatility of the investments. Because I'll stress, I did a retail investment education conference here in Virginia last Sunday, and I quantified that volatility is not risk, in my opinion. I know it's taught in modern portfolio theory. Volatility is inefficiency of information, inefficiency of trading. It's retail investors or jumpy advisors making interesting decisions, and I always tell them if they would do me a favor and call me first, I'll help catch their trades for them. But the volatility that closed-end funds or BDCs have, while they exist, if you own them directly, it's reduced through that wrapper, and yet the wrapper typically is one of the lowest cost structures available. It's very in line typically with most or many ETFs outside of like the ginormous simple equity ones. So I'm sure Kevin can add a few points, but from the outside perspective, we're not a UIT firm. We just have one UIT that we work with. It's neat to see the growth. It's neat to see that structure expand and give investors more options with their advisor.
Okay, Kevin, do you have anything to add? If not, I have another question here for John.
I'll just add very quickly, UITs have their own set of pros and cons and risks associated with them, and I would encourage everybody to do their due diligence on the product. NICSA has a very good UIT educational brochure on their website that I would encourage everybody to look at. And I personally believe that a large portion of the reason why UIT asset growth has accelerated in recent years is related to not only the ongoing evolution of the strategies and the securities that are used in the portfolios, but also the record low yield environment that we've been operating within and the opportunities that UITs have to provide for a high level of income.
Okay, great. John, one more for you. UIT strategies to consider for a rising rate environment.
Yeah, so I mean, honestly, the three we presented here, I think, as Kevin and I talked about this webinar, was the three that I think really help. I mean, there's a pure hedge, right, for investors. The BDC sector, and a lot of the advisors we've met with on the road with his guys have been traditionally private BDC buyers because, you know, that's a big part of the market. But one of the benefits of that, you know, that UIT wrapper is that you can change your mind during the life of the trust. It's got that daily liquidity that a lot of people weren't familiar with the structure. So again, these questions can go back and forth between either of us, but these are three ways, either through a focused hedge, a sector that's underpriced and does well through rising rates, and through a diversified multi-sector class that Kevin built with the diversified dynamic sector income, can really help you get that income that can actually go up when rates rise. Because in all the conversations I have with individuals and advisors, it's, well, when rates rise, everything bond-like will get beat up and go down. Well, yes, treasuries, yes. Boring muni bonds, yes. So, but these are strategies designed to give you access in a diversified way outside of that. So if Kevin has anything to add, he's welcome to jump in too.
No, that sounded good, John.
Okay. One last question that's coming through here for Kevin. How are you positioning your various investment models for an expected rise in rates for the fall of 2015?
I think just the way I discussed, what we looked at initially was the beginning stages of the last tightening that followed the blueprint we think the Fed will embark upon this time. So that really looked at the beginning stages of 2004 when they started their 25 basis point incremental hikes. We looked at those sectors and those asset classes, whether on the fixed income or the equity side, that tended to perform best on a relative basis. And some of those sectors are those sectors that I spoke about earlier. So some of those sectors were more late cycle bloomers, and the other ones actually started to perform early on in the hiking cycle. So, you know, again, on the fixed income side, it was areas such as, you know, the floating rate senior loans, some high yield, some convertibles. On the equity side, it was the energy, the materials, the industrials, the REIT side of the portfolio. So those are the areas that we like right now and how we're positioning our portfolios. But we're also moving more allocations overseas into international developed, to a lesser extent emerging, with an overweight towards Europe on the developed side, because we do believe, at least in the growth side of the market, there's more growth opportunities intermediate to long-term overseas than there are in domestic markets.
Very good. I don't see any more questions coming in. If anybody, again, has any questions, we'll give it a minute to come through. But otherwise, I think we've touched on pretty much all of them. In the meantime, I just want to remind everybody, if you were interested in CFP credits, after the webinar, be sure to write to us at events@pristineadvisors.com. The event will be replayed. We'll send out that information probably about an hour or so after this webinar wraps up. So I don't see any more questions coming through. So I think at this point, this would conclude the webinar, unless John or Kevin have anything further that they want to add for the audience.
I'll just say for those folks who don't know us, I try to record videos regularly off our Vimeo channel. We have a blog that I try to post articles and webinars to off our website at cef-blog.com. We have a newsletter, I said the Scott letter, that we still publish and then send out other information to folks. If you sign up on our website, it's typically 1 to 3 emails a month. It's timely but not overwhelming. So we'd love to engage with any people that have questions about the closed-end fund structure and sector, and I'm sure Kevin's got some good resources on their end too he may want to tell you about.
Absolutely. I appreciate everyone's time in joining us on the call today. Hopefully everybody learned something about UITs and BDCs and some of the research that you can run in your own practices to position your portfolios against rising interest rate hedges. We offered a couple of products as examples of the research and the work that we've done, but hopefully everyone on the call today has learned something as well.
Yes, and at this time I'd like to thank our panelists, John Cole Scott of Closed-End Fund Advisors and Kevin Mon of Henyon Walsh. Again, you can find information on our webinars on our website at cefnetwork.com under the Events tab. So thanks everyone for your interest in participating, and thank you again for our panelists for giving us a great overview of rising rate UITs. Appreciate it.
Thank you, Patty.
Thank you.
You're welcome. Take care.
Bye now.
Bye.